Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus podcast. So happy to have a good buddy on the show today, Chris Roberts of Sterling Rhino Capital. If you guys have been swimming in this ocean for very long, you've probably run across Chris either on one of his, do you still do the other podcast, Chris? Are you doing both now?
Yeah, I have both.
Yeah.
I have an original podcast. Now there's a second one that we have. Yep.
So Create Your Fortune podcast is Chris's podcast. And then the other one was called Charging Forward, if I'm not mistaken, right?
Yeah. Yep. Absolutely.
The Sterling Rhino Capital reference there, Charging Forward podcast. So if you haven't caught Chris on one of those two podcasts, do that. But Chris has also been a guest on everybody else's podcast and speaks on stage and at some of these major national conferences. So chances are you've run across Chris, but if you haven't, you're in for a treat. Chris and his partner, Chris Wilcox at Sterling Rhino are just crushing it in this space. And we got on a call yesterday just to catch up here at the end of 2023, December. And I said, we got to get you on a podcast here immediately. And he's one of our very rare repeat guests to be coming back on the show. But Chris, dude, it's always great to have a good friend on the show and somebody that is also just killing it in the space. So welcome.
Thank you, Tate. I appreciate it, man. I'm looking forward to sharing as much knowledge as I can with the crew here, and look forward to having a lot of fun with you. We always have a good time, Tate, going back and forth.
Yeah, we sure do. We sure do. Well, for those folks that didn't catch you the first time around and for some reason haven't heard you before, Chris, just give us a little color into Chris Roberts and your background, how you got to where you are today in real estate and investing and syndicating and all that good stuff.
Yeah, thanks, Tate. So my story, I've been an entrepreneur for a long time, 25 years or so. Started out in a sales and marketing career, and as I made money, I saved it and invested it. Started buying a little bit of land at the coast, flipped it, got into my first fix and flip, I don't know, maybe 9 years ago or something like that. And was working on like the Burr method. Right. And developed a little bit of wealth, but realized that I wasn't going to be financially free doing that. It was just a lot of work, as most people know that may be listening. If you're dealing with single families, it can be a challenge. So we got out of that space, jumped into multifamily, I don't know, around 4 years ago or so. And today I've put myself in a position to exit corporate America and have a six-figure passive cash flow. We have, I don't know, around 1,300 units or so. We've done value add, C and B primarily. Now we're into new development, luxury in some key markets like Denver and Phoenix, and we have several funds. So we've kind of grown fairly quickly. We've exited several deals, and we'll be selling another 5 next year. So yeah, it's been a wild ride. We're excited, and we love sharing our knowledge with everybody.
How have you decided? There's so many takeaways there and things to get into, but right off the bat, how have you decided, number one, to sell next year 5 different properties, and how did you have you decided like which ones to sell?
Yeah, thank you for that question, Tate. That's a very good question. And the reason I feel it's a very good question is because the market tells you really when the right time is to sell, right? You have to do what's best for your investors. And there's been opportunities that we've let go very early on in their cycle. In other words, the projected model was, let's say, 4, 5, 6 years or so, and we sold in 18 months. There's other opportunities that perhaps we could sell in 18 months, but we decide to hold for 5 years. And the primary focus, I would say, is the investors. We're always concerned about how we maximize their returns. And in today's environment, part of what dictates that is the fluctuation of interest rates, right? If you have adjustable rate mortgages, your payments are getting higher, even if you have a cap that comes in and subsidizes some of that. So you have to look at that. Obviously, with the economy being slightly challenged, you've got usually a little bit more in delinquency. But what you also have is you have sellers that are still trying to get prime dollar for their properties, right? So picture this. Let's say you bought a property I'm just going to give you one example. You bought a property a few years ago at $34,000 a door, okay? And your model conservatively said, well, in 5 years, if we could sell this thing at, let's say $75,000 a door or something, that would be a great return for the investors. You have other folks in the market who today maybe are trying to get that 75 a door when they bought at whatever number. And they're looking at the challenges in this market and they're saying, well, we're not going to budge on this price, right? This is what we need for our investors based on XYZ. Whereas if you bought the property, let's say a little more aggressive for the market, maybe you used less leverage, you name it. There's lots of things that you can do to pull these levers, right? To sell these deals. Yeah. What you're finding is there's less inventory on the market, right? So in our case, we did buy several deals that were $35,000 to $50,000 a door. And today we could sell those within, let's say, a few years of acquisition and still net a really healthy return ahead of pro forma in some cases without waiting 3 to 5 years. So you say to yourself, would the investors want a return that exceeded projections today, or would they want to hang in there? And with some of the uncertainty of the market, investors are like, man, I'd really like my capital back. Now, we don't base our decision based on what investors want. There's no way we could micromanage hundreds and hundreds of decisions by all these different investors. We have a model, but the model is based on what's best for the investors. We speak on their behalf. And some of these deals, we want to try to exit at a target number. But we will not exit deals if they're below pro forma. Let's put it that way.
Yeah. So you are able to, even in this market now, which has shifted so much, with interest rates spiking and cap rates starting to decompress, and the buying power of the buyers just not being what it was to a very significant degree, you're able to still sell and outperform your pro forma numbers, even with this shift in the market.
Yes, we exited 2 deals around the first quarter, which was when the market was turning, but there was some uncertainty in the marketplace. I mean, we saw banks getting a little jittery, and I'm not going to tell you the exact numbers. They're up there. They exceeded pro forma, but we sold 2 deals this year, no problem. We have some offers on a few of our properties now, and for next year, projected to sell next year. And those numbers are favorable. There's nothing that concerns us. Now, the question is who could buy in today's environment, right? Yeah. Well, I'll give you an example. We have some properties that were bought under the LIHTC category that allow us tax exemptions that are far more favorable for a buyer because they have less cost and overhead overall, right?
Yep.
And there's some nuances to that, but that's an example. There are other examples where you might have a cash buyer. Now think about this. A lot of the smart folks with equity were building up during this peak, knowing there was going to be a bubble, so to speak. I don't think there's a huge bubble that's going to burst, but let's just use that term. Let's say there's this bubble. Well, a lot of this equity was sitting on the side because there was nowhere to put it because everyone was asking too much money the last 6, 9, 12 months, right? For the most part. So what you have now is you have this surplus of equity. There's no shortage of equity. There's equity all over the place right now, right? So that equity could come in now with the way debt is and actually be a lender if they want and come in under what banks are lending. Or they can come in and pay cash for these properties knowing that in the next 18, 24, 36 months for sure, rates are going to stabilize, likely come back down once they hit their peak. And then the economy is going to start booming again because that's what happens when interest rates drop. And I'll just give you one quick example. If you look at the 80s, interest rates were 18.5%. And within, I think it was 6 to 9 months, maybe a little bit longer, they plummeted to 4.5%. It was a staggering drop, right? And that was one of the craziest examples, the 80s. But you can go back in history and look at most of the recessions, and you'll see the same thing. So if you look at history and the type of recession we're sort of going into, if you will, it's favorable for those who had equity. And so that equity is out there. The question is, did you buy right so that you can exit? Right? Or do you have to hold your ground at the price you absolutely have to have? And that's the difference. And if you bought right, which, we bought a few properties really well, we could exit. There's some that maybe we say, we're probably not going to execute the way we'd like because of interest rates, and we're not going to have a cash buyer likely on this asset. So we'll hang in there a little bit longer.
Yeah. So one last question on this subject. Why not hang on with all of them, I guess, at this point, knowing that there are brighter times ahead and lower interest rates and probably higher sales prices ahead?
Sure. Well, you could. And again, it's subjective. Every market, every deal. I mean, I think currently we have like nine properties out there. And then we have another 6 that are under new development, right? The luxury stuff we're building. If you look at all those markets and the assets, again, it's neighborhood to neighborhood. Literally, you could have C or B properties and within 3 or 4 blocks, it could change dramatically, right? If you look at all of that, you say, well, hold. I had folks when I first started in the business saying, I'm going to buy smaller buildings, 30 units, let's say, and we're going to JV them with a smaller group instead of syndicating, right? We want to own them outright. So we're going to buy them. We're going to own them. We're not going to have investors. We went a different model. We brought in investors and we ended up with, 1,300 doors. That's those same people that were talking to me about that. They maybe have 60 doors, 90 doors today, but they own them among 3 or 4 people instead of hundreds and hundreds of investors. I would say our volume and equity is much greater, right? And I would say that if we held on to them all for 5 years, the potential is there for that equity be much greater. But if you say to an investor, I'm just going to give you a hypothetical. If you say to an investor, hey, today, 3 years early, we can give you let's just say a 32% annual return. Okay. Pretty high return, but let's just say 32%. Or you can hang in there another 3 years with us, and we're going to give you potentially in 3 years from now, with the way things are today, who knows, maybe a 40% annual return, or you throw the number out there, 60% or 20, we don't know, right? So it's almost like you can't time the market, but if you have feelers out there, and a lot of these real deals are done off market, right? They're done with whisper prices and such. You owe it to your investors to take full advantage of that opportunity and have that bird in the hand versus taking a chance. Now, you can say argument would tell you over the last 50 years, if you hold on to real estate, the numbers tell you it works out as long as you have enough reserve capital, you got your debt set up right, and you bought the property right going in, you're probably in pretty darn good shape. And in some cases, we may hold longer, but other times you get a good buyer on the line that's qualified, and you're going to take it because your investors are going to be happy with that. And guess what? They're going to want to jump into the next deal with you. Right.
Which you'll have set up and teed up ready for them to go. So, and that's perfect for you too, because you're recapitalizing and releveraging and doing it all over again. One of the things that you just mentioned that I don't want to gloss over, Chris, is having enough cash reserves for your properties is huge. And I'm saying that from this is the voice of experience talking about, we have 7 different properties. And when you're raising capital, you just have to raise more than what you think you're going to need, because inevitably there's going to be costs that you don't foresee, whether that's in the purchase or in the CapEx, the improvements, or even just in the general operations of the property. Stuff's going to come up, and not having cash reserves to handle that stuff can be very, very painful, and can leave you really scrambling and kind of in the weeds, worrying about stuff that you really can't even afford to be worried about. So that, and then you mentioned long-term fixed debt. That's so key these days, and buying right. All 3 points that you made there are just massive.
Yeah, absolutely, Tate. And I'll tell you one last thing too is there's a lot of little nuances in multifamily. Folks get wide eyes. They come in and it's like, I want to be financially free, or I want to own 1,000 doors, or I want to own $100 million worth of assets. And I always tell them, don't be so goal oriented. Yes, it's important to have goals and write things down, but don't fixate on that stuff, because it can derail you. It can take you off of what's most important, which is conservative underwriting, raising enough capital, and following through on what you say you're going to do, right? Like, for example, you touched on the capital, right? When we've purchased assets, we've had fixed debt, Fannie Freddie, we've had bank debt, and we've purchased caps, right? And caps are really important because they protect you against these fluctuations of interest, right? Like, for example, interest rates are climbing. Now, they can only climb so much if you bought a cap. Now, before this chaos in the market, you could buy a cap, which is basically a ceiling on which the bank can raise debt on you or raise your interest payments of maybe $50,000 to $75,000. To buy a cap today, it could cost you hundreds of thousands of dollars, right? Yeah. So well worth the investment, because that cap insurance, if you will, comes in and writes a check for some of the difference. So if all of a sudden your interest payment went up $22,000 the very next month, which you were not prepared for, you can get a check actually being deposited directly into your account from that cap company, anywhere from, let's just say for argument's sake, in that example, $20,000 interest increase on a monthly basis. You can get a checks from $10,000 to $15,000 or more. And that's like a security blanket for it's like an insurance, kind of like gap insurance on a vehicle. So very important, raise the money. I know it's hard for some people because you're trying to make deals pencil, especially today, and you're trying to show a decent return for your investors. But here's the thing to remember. This is a long-term play, even if you have the opportunity to sell early. So it is really important to just condition your investor base to understand that you're investing in real estate. And it's going to take time to execute. People put money in the stock market knowing they're going to be in there for like 30 to 40 years, give or take, right? But you get into real estate and it's like, well, no, I've got to be out of this thing in 3 to 5 years. Well, if for some reason it drags out to 7 or 8 years, but you still yield a great return for your investors, they'll forgive you for that. But if you run out of money and lose all their money, they'll never forgive you for that, right? So raise the extra money, set the expectation for the investors on the returns. And even if they know, hey, we've raised an extra $500,000, which is lowering your returns, there's a good chance we're not going to need it and we'll kick it back, right? Far better than running out of money, no doubt.
Yeah. So key. Chris, you've become and are a master at this investor relations game and raising capital and nurturing those investor relationships. And you have a fund. You have one fund now or 2 funds? I can't remember.
We've had 3, but currently we have two going. One's a crowdfunding platform, and the other one is a 506c.
Yeah. So, and for listeners, the 506c designation on a fund just means that it's the same thing as an individual deal. You can go out and you can advertise publicly, openly for the fund. You can talk to people like a podcast audience about it if you want. But everybody that invests in it needs to be accredited. They need to be accredited investors. Are there any other 506c nuances that I'm missing there, Chris?
That's the gist of it. I think most 506Cs require not only accreditation, but usually a minimum that's fairly high. It's a pretty high barrier of entry, and that's usually 50 to 100,000. So you'll find that even if you're an accredited investor, just because you have net worth doesn't necessarily mean you have 50 or 100 at a pop to throw into an investment, right? Mm-hmm. So that's where having a crowdfunding platform or even a 506B with no minimums can kind of help you along the way, or I say a low minimum, right? Yeah.
If you're starting your first fund, would you recommend a 506C?
Yeah, I would. I mean, you've got all these different funds that you can research. First of all, it starts with a really good attorney. So you're going to want to research finding a syndication attorney that understands funds and can help you structure all that. The second thing you're going to want to do is line up a good CPA firm that understands funds and real estate, right? Because you'll find that if you start going, there's a lot of, based on the type of fund you start, there's a lot of accounting and cost that goes into that, right? So line up your attorneys, line up your CPAs. And then the next question is, what do you feel your base is like? For example, if you've never raised before, it might be hard for you to start a fund. Okay. If you have raised before and oh yeah, I've got, let's just say 80% of my investors are accredited. Okay. Well, then maybe you start an accredited fund, which by the way, a basic 506C fund, it could cost you anywhere from, $7,000 up to maybe $20,000. It just depends, right? To get it all set up and rolling. And it could take you anywhere from 6 weeks to 6 months, but usually it's just a few months. Okay. There's like these Reg A's and all these different funds that have accredited, non-accredited rolled into one. And those get a little more complicated. They take far more time and approvals through the SEC and all of that. And then there's crowdfunding, right? So we have crowdfunding in 506C. Now, you'd mentioned earlier, Tate, about the if you are going to advertise, it has to be a 506C, and there's some other funds you can advertise as well. But what allows us to kind of indirectly promote the crowdfunding platform is it's going through a SEC filing public offering crowdfunding platform. So in other words, it has to be promoted, like it has to be out there, right? So there's no developing a substantive relationship on my side directly with those investors, but I can't generally just solicit them. They have to come in through that crowdfunding platform. So in other words, I'll give you one quick example. We have live landing pages that we use that are updated constantly on our new development projects, right? So we have these funds that have 6 new development luxury class apartments in them. And we're always updating them, drone videos and all kinds of cool artist renderings and whatnot, right? Financials. On the crowdfunding platform, there's a very specific flow, if you will, that has to be followed. And so they have us update a lot of information to them directly, and then they get it approved. It has to go through all kinds of legal, and then that's all approved and it stays on their platform. And so if an investor comes in, it has to go through their platform. They sign the PPM through their platform. And then ultimately they transfer funds over to us when we request them. But basically the management of those investors is done through the crowdfunding platform. And as a result, they technically are the ones doing the advertising and promoting the fund through their platform. But we generally don't promote it. We just simply say, hey, we have offerings available to accredited and other types of investors, XYZ. And if they come in, we direct them to the crowdfunding platform.
Where would a listener go to check those out?
Yeah, it's a great question. So to check us out, it's at sterlingrhinocapital.com, and you can get all the information there. If you're exploring crowdfunding platforms, there are many of them, right? Tycoon Invest is one of the companies we use, and they've set up everything for us. It took quite a bit of time. It took quite a bit of cost. And it also costs you along the way. So if you're looking at starting a crowdfunding platform, understand you're going to pay for it. I mean, it's not like you just open it up and there's a little $10 service fee. They're going to take a good chunk of your, let's say, profit, if you will, along the way through fees and things of that sort. Again, not for the faint at heart. It's not something you want to start if it's your first time. A 506C might be the easiest way to go, or 506B, allowing you those 35 investors. But it all depends on if you want to advertise, you're going to go through your network. Do you want access to, a crowdfunding platform's, let's say, investor base? because a lot of these crowdfunding platforms are seed capital for software companies and startups and things of that sort. So you got to understand that just because you start with a crowdfunding platform doesn't mean you're going to just drive investors in droves, right? You have to research that and do your due diligence. And there's no substitute, in my opinion, for just the good old ground and pound and just going out and networking with your base and then relying on referrals from people because you deliver over and over again. That's the best way to build up your base, in my opinion.
Yeah. Yeah, it certainly is. I mean, the best source of a new investor is a referral from a current investor. There's no question about it. What for you guys what was the inspiration and the motivation behind starting a fund? At that point, you were doing deals, you were raising capital for individual deals, and then you started a fund. What was the thinking and inspiration behind that?
Man, that's a fabulous question, Tate. And I'm going to give you as much detail as possible because I think this is very important for your listeners. A couple of things. There was a lot of miscommunication, misnomers, misdirection, if you will. I know that's a lot. But when I first got in this business, it was find deals and you'll find money and you'll find deals, hire a mentor. I mean, you name it. Like there was all these things. And I very quickly realized that equity was the key. Raising money was the key. And as we began raising money, deal after deal, and in one case, Tate, we had 3 deals going in about 6 months. And I think we raised around $18 million for those deals. And that was very stressful. It was very time consuming, right? And you had tight timelines constantly that you were trying to hit. So it's really important as a new syndicator, if you will, listening to this to understand the reason you would start a fund is because it alleviates a lot of the pressure and the time constraints. And secondarily, it gives you the opportunity to raise and then if needed, partner with somebody and then bring the equity versus, hey, I've got a deal. Well, if your deal's not right or the equity doesn't know you or you don't have credibility, just because you have a deal doesn't mean you're going to close it or even get the equity for it or even find partners for it. Whereas if you have the ability to raise, you've built a thought leadership platform or you have a fund started or whatever, then that gives you a lot of power because there's a lot of power in equity, right? We were talking about equity earlier, how it's sitting off on the sides. So there's a lot of big money that's just been waiting for an opportunity like this, thinking they're going to prey on syndicators maybe who really need to sell versus want to sell in this environment, right? And that same sentiment was going on during COVID, but that never happened. People were talking about how there's going to be fire sales and it's going to be all these deals during COVID. We bought a bunch of deals and we found a couple, but there wasn't people just selling their properties, well below cost. I mean, COVID passed and everything was fine. So if you're going to consider starting a fund, I think that's a great idea. I think it'll ease the pressure on you and it'll allow you to raise whether you have an open fund or a closed fund for a longer period of time, giving you the opportunity to shop whether it's partnerships or deals you want to put your equity in. And the last thing I would tell you guys in closing on this, and of course, Tate, feel free to ask any questions, is understand that a lot of the scaled syndication companies or big sponsorship groups, the volume guys, if you will, a lot of them partner. A lot of them have equity coming in. It could be groups that raised equity that are going to take on some responsibility because you can't just raise money and get on a deal. You got to have a relevant partnership or workload there associated with it. Or they're bringing in private equity along with the bank debt. So don't feel like, I can't partner with someone or, I don't know if I'm ever going to get in on a deal or whatever. That's the name of the game, especially when you're scaling, because raising a couple $100,000 versus raising 3 million to 10 million to 20 million, they are massively different. I mean, there's a Grand Canyon between those, if you will. And don't think just because you can raise a couple hundred on your very next deal, you're going to raise 3 million. Yeah. That's not likely, although it could happen. So a fund is a way for you to bridge that delta, I guess, if you will.
Chris, I think you could write a great little ebook or book on this because of the perspective that you have. And and your experience with it. It's super valuable. And for syndicators like me, I mean, we're where you were when you started your fund. We're raising money for individual deals at a time. And you're absolutely right. Up until recently, we had to be really competitive with our offers in terms of due diligence deadlines and closing deadlines. And we had to keep those as short as possible to get the deals under contract and get the seller to play ball with us. You put yourself under those deadlines and you got to raise a few million or 5 million or whatever it is to get the deal done. It is grade A stress, man. Like it is legit stress. And from what I hear, there's times that you don't get the raise done and you lose the deal that's very real. And obviously it's a kind of a nightmare scenario, but it happens. When you guys, I'm just kind of walking through this in my own head about it. When you guys started the fund, was the 506c first?
They were kind of simultaneous. One took a little longer. The crowdfunding takes a while. So we started with the frame of mind that we would do them at the same time, but one took a little bit longer. And we had a lot of previous investors. We have a lot of investors. We have a good following and a lot of repeat investors that were kind of sitting, waiting. Hey, do you have something? Do you have something? Right? This kind of thing. And so that's another challenging thing is when you're exiting deals, where do you put the equity all of a sudden? Like if your investors know, like, and trust you, they want to jump back in, where do you put them if you don't have funds opened up? Yeah. They sit there and then they jump in maybe with someone else or they don't invest at all, right? Yeah. Plan on probably minimum of 6 weeks for any fund. Plan on sometimes 3 to 4 months on a crowdfunding setup. But again, this is subjective. It could change based on the company you use.
What did you guys do to let everyone know that you had started it? And I guess, did you do any formal marketing for it? How did you handle that?
Yeah. So, and if I get off track, bring me back, but I want to tie this into not just starting a fund, but what do you do to drive investors in? And how do you measure the success of what you're doing? This is really, really important. Yeah. I talk to a lot of people about raising money, and I know you can hire mentors and all that, and that's great. And they'll teach you a lot, but it's actually pretty simple. First of all, you have to have some sort of brand recognition or thought leadership in some way. It could be one thing, but you got to be somebody to drive people in. Otherwise, they're not going to want to jump in and give you $50,000 or whatever. You have to have a place for them to go. So you have to have a CRM of some sort to track all this stuff. So let's say you get a couple of people together and you guys start a fund. Well, you need a place for them to go. So whether you're sending out newsletters or you're advertising on social, or you're at events, you've got to be able to drive them in. You could drive them in through text messaging. Hey, text the word whatever. They sign up. They go into your CRMs. You could have them go to your website and fill out a form, and that puts them in. You could have them go on Facebook and fill out a form if you're promoting or whatever, right? But once they get in there, how are you now measuring the success of who's coming in? Are you walking them through the journey of investing in your deal, or are you just educating them with no real call to action and you're not really closing the loop? You're just getting them in, and it's like, well, I know I have 500 contacts or whatever, and I know they're clicking stuff, but why aren't they taking action? They came in off my ad, or I drove them in at this meetup or whatever it is. So this is really important for anyone listening. Make sure that not only do you have maybe some automations in a CRM, like I'm just going to give you one example, ActiveCampaign or Mailchimp or whoever, but that you are finding a way in your own way to measure that. Now that could be calling them. That could be text messaging them. That could be following up with personal emails. That could be all of the above. Yeah. But you want to get to the yes with an investor. And if they're not interested, well, then maybe they need more education. But you need to measure all this stuff constantly. And here's the crazy thing, guys. I get investors all the time that are just shocked that they're talking to one of the co-founders and CEO of the company. But I love that. I love talking to the investors. So I would rather be talking to the investors than anything else, because one, I feel I can articulate our deals, one of the best at articulating our deals because I'm in everything all the time, right?
Yeah.
And I have a lot of energy and enthusiasm because I love the business, and investors feel that. So don't think you're too busy, so you need to outsource it, or that, oh no, once they get through them, they can get to me. You might lose investors that way, right? You got to be in your business all the time, especially in the beginning, to understand what's working, what's not working, and what you need to do to close the loop to get investors to convert. Right? You won't know what's missing or what's actually working or not working if you are not in it and don't have some tools to measure it. Yeah, it's not about just putting a fund together or even offering a deal that has decent returns. You have to have a reason for them to want to do business with you, and you got to measure all that stuff.
Mm-hmm. How do you measure? Do you have like a KPI tracker or what?
We lead people into various things: Google Docs, spreadsheets, our CRMs. They're tied to automations. We have Facebook lead forms we use for tracking. I mean, we do a lot. We have YouTube that we use sometimes, but a lot of it is manual. A lot of it is. I'll give you an example, Tate. Let's just say, for argument's sake, you run a Facebook ad. Okay, for whatever reason, you run a Facebook ad, and it's 506c filing or whatever. You run a Facebook ad, and you put a form on it, and some people are coming in off that form, and you have some good questions, and they're saying, "Yeah, reach out to me. I want to know." Well, you can either set them up in an automation where some automations automatically go to them, some emails, or you could just go through and you could text message all of them if you're asking for their phone number. Hey, I saw you came in. You want to learn more about our returns? Blah blah blah. Can I hop on a call with you? Or the automation has a calendar link for them, and they could just go right there. If you ever sign up for ours, you're going to see that I put a custom video that was well produced together. So one of the first things people see when they come into our system is a professional video of me explaining what's going to come next and encouraging them to get on a call with me so they can qualify to see our offerings, right? That's important because I want them to see that Chris Roberts is probably one of the guys they're going to talk to. And I want them to understand my vibe, understand how they might resonate with me. And they're going to get a real clear picture on a video that's on their terms. They can watch it or whatever, versus feeling like they got to just hop on a call with me. Yeah. Right. And then from there, there's a bunch of other calls to action. So we've gone through this process painstakingly through time, and we know what works. We've seen a lot of success. I just gave you a fraction of our process, but we know what works, and it boils down to know, like, and trust. And referrals are really good for that. And doing what you say you're going to do as far as your returns and obviously having a thought leadership platform that highlights some of your experience. Now, one last thing, Tate, if you're a new syndicator and you don't have a lot of experience, because I was there, I didn't have a lot of experience. You need to figure out what value proposition you can bring to your website or your newsletters or whatever you're going to use as thought leadership, which could be, hey, I wrote a little book. Or, hey, I'm an IT person and I understand analytics and I'm really good with numbers. And this is what I've analyzed 100 times this week on these deals. Or you name it, you come up with some sort of thought leadership that defines you as an expert of some sort. And then you share that with the world. And at least it gives you some credibility. And don't cut yourself short. We all add value. Just many of us are not good at articulating what that value is, but you're going to need it to drive investors in if you don't have a lot of experience.
Yep. Yeah. Know your superpower, right? Like know what you're good at, know what part of the business lights you up. Even when you haven't done very much of it yet, what are you most excited about? Like, is it talking to investors? Is it talking to brokers? Is it underwriting? Is it raising capital? Know what you're good at, know what you love, and double down on that is something we talk about all the time on the show. I can tell, Chris, you really love you love the whole thing. I know you love this whole thing, but you love the investor game, don't you?
I really do. And you know what I love about it, Tate, the most is I'm a people person. I know people say that loosely, but I really am. Tate, when we talk, I mean, we spend a lot of time on the phone and I'm busy just like everybody else is, but I really want to understand people's motivation. I like understanding what drives them to want, whether it's financial freedom or to invest passively or whatever. And I enjoy hearing the stories because what made me who I am today is listening to other people's stories. It was being mentored by unlikely mentors throughout my life and asking the right questions and being a good listener and then just putting in the work. And so I enjoy giving back and sharing with people, just like on this interview today as we talk. And I get fired up when I hear the stories from the investors. And it also teaches me a lot about how we communicate with them. You know, we ask them, like, what's the one question you would ask if you got on a call with us? What's the main driver and why you want to invest? And I don't mean returns. I mean, give me another reason, right? Stuff like that. And it's just a lot of fun. So you've got to enjoy people if you're going to do that. And if not, then find somebody on your team that really does enjoy it. Because I've certainly been on calls with directors of investor relations that are very staunchy and boraxy. And that, for me personally, that's not the kind of person that I want to give my $50,000 to or whatever. I want to relate to somebody. I want to feel a trust there. And it's hard to do in 30 minutes, right? It's hard to do with somebody in 30 minutes.
Yeah, but not impossible. And I think the enthusiasm and passion, as much as anything, speaks volumes to an investor, right? Because they are in fact leveraging your confidence, your certainty, your excitement, your certainly your experience and conservative underwriting and prudence and all that stuff. They are that's what they are investing in, is you. And, you know, so if you're a powerful communicator and you're passionate about what you're talking about, you can make a pretty big dent, even in a half-hour conversation. I'm sure you've had a lot of success even in those circumstances. So yeah, it's really great stuff. It's great stuff for me. I've said that 2023 is going to be our year for really upping our capital raising game. And, you know, listeners, for you guys, be thinking about, like, this episode's going to come out here before the end of the year. So you'll be listening to this ideally in 2022 still. Think about 2023 and what it is for you and in this part, in this business. What part of your business do you want to see really thrive and flourish in 2023? For us, it's raising capital. We've discovered, just like so many, that the bottleneck in this business for us has often been, capital, just having access to equity to get deals closed. And deal flow for us is something that goes pretty well. Our broker relations game is pretty good, and we get a good deal flow in our markets, and we have opportunities. And so really dialing in this aspect of the business is so exciting to me. And one of the reasons I wanted to get you right on the show, Chris, and appreciate it. So what other words of wisdom on the capital raise before we kind of let that one go? Any kind of final words? Like, if you were to go back and coach yourself at the beginning of your syndication career, on the capital raising side of things, knowing what you know now, what might you say?
Yeah, I think the number one priority day one would have been, which we did fairly early, but probably not early enough, would have been just the tracking and measuring of things, right? We've learned a lot about that throughout the years. And, let me just give your listeners one example. When we first started, it was tough to raise $300,000 as an individual. So like me personally, right? The first deal, I raised like $300,000, and it was tough. And it was like a handful of friends and family. And I mean, the next deal was like $1 million plus. The next deal was like 3 million, and so on. And it happened pretty rapidly, right? Because we scaled through our system. So here's what I'd say is, don't underestimate the power. You can't overdo it measuring and tracking what's going on with your leads, if you will, right? Your partners, your investors, if you will. For example, it's shocking how much money we've raised through this tracking process. Like I've had people come in off of advertising that invested $1 million with us or $500,000 with us. That's more than our entire raise, like on our first deal almost, right? Our first raise was like 2 million total. So I'm exaggerating, but like, and going from that in less than 4 years is pretty astonishing, right? Where a stranger comes in and within a few phone calls, they're giving you $1 million. That's real, but you don't get there without tracking and educational materials and professional videos. And I'm not saying you got to spend thousands of dollars, but what you're trying to do is show these folks that you're serious, you're credible, you're knowledgeable, and that you're accessible. That's probably the most important thing, right? So that they look and see me on a video, and they know that if they talk to Aaron, our director of investor relations, for some reason, that if they want to schedule a call with me, they can schedule a call with me pretty quickly. Chances are they're going to get me anyway, because I love having these calls. But the point is this: track it, measure it. Don't cut yourself short by thinking, oh, I'm just going to set up an email newsletter and only a third of my people are ever going to open it. And a lot of people of those third don't even want to read email. They open it because they know me, but they don't want to read it. They're video people. Oh, okay. Well, they saw it, but then they forgot because it got lost in the email. Well, do you have a social media platform? Are they connected there? Are you promoting? Are they going to see you regularly? And so on and so forth, right? Because you'll find you have people that are qualified that wanted to invest with you, but they just got busy. Stuff got lost in the shuffle. And because you don't have a system and a process to attach yourself or connect with them in multiple ways, you could lose them. It's pretty amazing, guys. So if you're looking to raise capital, you need to do some of those things. And there's more, obviously, but that'll set you on a path to success sooner than later if you do some of those things.
Yeah. Listeners, guys, you really need to go to sterlingrhinocapital.com and check out the website and all the resources that it has. And Chris's website is one of the sites that, as we're in the process of revamping, redeveloping our site, and really recontextualizing, reframing our site from being a site about a real estate investment company to a site about investor opportunities, right? And I think Chris's site does that really, really well. Like, you go to the homepage, and it's all about how it works, and it's very educational. It's like what to expect when this happens, and it's just you've done something different on your landing page, Chris, than anyone I've seen before, which is I've seen videos on landing pages before, but not to the degree that you guys have them. And I really like how you have these different, like you said, professionally made videos on your site that are easy to understand, easy to access. Have those been successful for you?
Yeah, absolutely. And this was a journey, right? This is a journey. We didn't know at first. We did a lot of our own little YouTube videos, and we said what we thought people wanted to hear, but we didn't ask enough questions, right? And then we realized over time, who are we and how do we project that to the world? So if you look at our first video on the landing page, that's a professionally branded video. That is me at construction sites, and it's me talking to investors, and it's me in an office showing like what we do. It's talking about our portal. It's very well done, but it gives you 3 minutes worth of what to expect if you want to go further with us and just better understand who we are. Then there's videos about like retiring early and what that would look like, and securing your financial future and your family, and just things that make sense for our investors, right? I mean, it's not rocket science. Instead of me getting on there and talking about cap rates, which, by the way, a lot of investors don't even understand, right? IRR versus, I mean, good luck explaining IRR. No offense to that stuff. We have it. We have blogs and all that, but it's more about who we are as a company, who we are as individuals, how we want to help people at their level, and then what to expect from us along the way. So as you go through, you'll see that. The other thing we're big on, Tate, if you look, is we're big on testimonials, man. I've got great videos from our investors. We've got great snippets of the write-ups they've done, because there's no referral like an existing investor, right? So if you deliver, they're going to love to scream it from the rooftops, right? So I encourage anyone to just check out our website and just learn. We've got great YouTube videos. We've got great Facebook. Jump into our CRM and learn. It's a great way for you to educate yourself. And we don't charge for this stuff, man. We want to help.
Yep. So Sterling Rhino Capital, guys, is where you want to go. Rhino, RHINO, of course. Really learn from Chris. He's got blog posts, most of which have accompanying videos as well. He's got his current offerings up there. And you can really see how he is catering directly to the concerns and the priorities of an investor that is looking at diversifying into real estate or just looking to invest in deals. Chris, man, I hate this. We're running up against time here. Unbelievable. You are you mentioned before how busy you are and yet how much time you and I have gotten to spend on the phone and in connecting and bumping into each other at conferences. I know that there's going to be listeners that are going to want to reach out to you. Is the best way to do that through your website?
Yeah, I would say definitely go to our website and just educate yourself. I get a lot of questions from people about things that we have available for free all over the place. I would tell you this, the most rewarding thing in my life is to actually help people get to a place where I am. I'm very blessed and grateful. I have a great relationship with my wife, my life, healthy, financially free, etc. Escape corporate grind, all of that. And I really enjoy sharing that knowledge with others because I want them to get there, right? Yeah. And we exude that feeling through our investor calls as well. We want everyone to have that. So just reach out. But you'll learn more just by going through all of our information. And there's nothing like being a passive investor, whether you passively invest with me or Tate or anyone else out there. That's a great way to learn as well. So I encourage you, if you're not, to passively invest with someone because you can start reading those reports and learning. And we're grateful to be here to share this knowledge. Please reach out anytime.
Yeah. Just to double down on what Chris just said about passive investing into your first deal. Like we've talked about this before on the show, but there's numerous ways to get into this business to kind of break the ice and bust into the industry. In my opinion, if you have the means to invest, $50K or whatever it is, the minimum that a syndicator might require, or maybe a little more, into a deal that with a syndicator that will basically kind of hold your hand through the whole process and include you on things like maybe occasional asset management meetings and property tours and, basically let you come along for the ride to learn, right? If you make it really clear to whoever you're investing with that, like, hey, I want to learn as much as I can during this process, somebody like Chris or myself, we're going to hook you guys up. And we're gonna teach you. Chris and I are both kind of natural coaches, I think, in the sense that we, amongst other things, just love to see people succeed, and we love to help people succeed. And like Chris said, get you to where he is or where I am. And so this investing passively in your first deal is a wonderful way to get your career started. So definitely be thinking about that. Chris, any kind of final thoughts before we set everybody loose?
Yeah, I would just tell you, anyone out there that maybe is in your own head and you're having doubts, the market's not right, the interest rates are too high, blah, blah, blah. I hear it all the time. There's no shortage of people out there around you in your immediate circle of influence or outside that are talking about all the negative, all the unknowns, all the uncertainties. But the reality is, if you go back in history and you look, it always works out. As long as you keep moving forward, you keep working hard, you maintain a positive attitude, you'll be fine. And all of the noise will be behind you. So I would encourage anyone that's trying to dive into this space, there is no time like now. Yeah. We've bought deals during recessions. We've bought deals during a booming economy, and we've survived just fine. It's believing in yourself and having the right attitude. And I know people say that, but you really have to do that because all of us get high, up, and all of us go way down. We get down, right? Because things happen. They knock us off our kilter. But you have to equalize all of that with a belief that it'll all work out just fine. Just get up every day and hustle. Just do more than you did the day before and you'll be fine.
You know what that reminded me of too is the Hal Elrod's miracle equation. Yeah. Extraordinary effort plus unwavering belief or unwavering faith equals miracles. And you really just hit on both of those. Just believing, and yeah, like Chris said, don't let this market throw you, because fortunes are made in down markets. That's just that's reality. And so there are opportunities, and will be even more opportunities coming up. So working hard now to get yourself ready for those is really, really smart place to be. So, dude, thank you so much, Chris. Really appreciate you, brother. It's good to have you on the show, and you just got this infectious energy. I told you last night when we were talking, you really have a way of inspiring me and bringing me to my highest and best. And so having people around me like you is a true blessing. So I'm very grateful.
Thank you, Tate. I appreciate it. And you as well. You're a wonderful individual, and I look forward to getting out there to do some mountain biking with you. And I'm grateful to have the energy. I don't know where the hell it comes from, but I just have this fire about me that just kind of keeps me going every day. And maybe it's just the knowing that there's work left to do, but I'm excited to be here, and I look forward to hearing the stories from you and your listeners as to what adventures await them and what they achieve next. Yeah.
Exciting stuff. Listeners, thank you so much for listening to another episode of the Apartment Gurus. I've said this before. I don't say it every time, but if you've listened to this whole episode, and you're at this point in the episode, and you're really taking this stuff in and taking notes or taking mental notes, and learning, you're doing good things. It's not the only thing you need to be doing. You need to be taking action as well. And but this whole specialized knowledge piece, surrounding yourself by mentors, whether they're real live mentors or digital mentors, like a podcast, kind of like this. These are all necessary parts of the equation, and they're gonna really ignite and fuel your growth. But don't be forgetting to take the action. The action is just what Chris was talking about. Grinding. But how'd you ground and pound? That's how you say it. You got to grind. You got to get out there and have those conversations when you're talking to investors or brokers. Whether it's deals or dollars that you're working on, that's where it's at, man. That's where the rubber meets the road. So good stuff, everybody. Thank you, Chris. Thank you, listeners. We will catch you on the next episode of the Apartment Gurus. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.